Hey everyone, welcome to LJ's Housing Market Update. Today is February 23rd, 2024, and let's get started with our interest rates. Your mortgage interest rates according to Freddie Mac for 30-year fixed conventional loans were around 6.9% as of the last reading of February 22nd, and for 15 years was around 6.29. And let's look at Mortgage News Daily's mortgage rates here. According to them, in the morning here at 10:15 a.m. Eastern Time, they were hovering around 7.16% for your 30-year fixed conventional compared to your 30-year FHA 6.68. So when you look at these headlines, these are your top tier scenarios in most cases where your credit scores is above 780, you're putting down more than 20 or 25%. This is going to be your primary residence, single family house. So if these factors change for you, you might have a different interest rate. So these are some of the factors. Your credit scores, the higher your credit score, the lower interest rates that you will get. Your home location also matters a lot, right? Depending on which state, which county that you live in, that might matter. Your down payment will matter. Your loan term, 15-year versus 30-year, matters. Your loan type, FHA, conventional, non-QM, all of them matter as well. Your residency and how many units you're buying. Okay. Next, guys, your buying power. Your buying power increases when these rates are decreasing. For last week, we have seen that the interest rates are coming back up over 7%. We have seen them come down as low as 6.65 last couple of weeks, or last week or so, and now they're trending back up. We are keeping an eye on this on daily basis, and you guys can do it as well. Now let's talk about affordability. And we're going to give you a scenario today where we're going to talk about one family household income here, where we're going to show you if their monthly debt changes, how does that affect their affordability? So let's say they're going to purchase their annual household income is $135,000. This could be one person, this could be two people, as long as the household income is 135. Their down payment, they're going to use $65,000 down payment. This family has no monthly debt. Their interest rate, we're going to use 7.16 as a national average. They may or may not get this. 5,000 as their property taxes and 1,500 as their property insurance. So at DTI, their debt to income ratio at 45%, this family can purchase a house up to $733,000. But how about if their monthly debt changes from $0 to $250? If that's the case, their affordability will decrease to $696. How about if they bought a new car and the car payment is larger than $250, and maybe it's a luxury car, and now their monthly payment is $750? Maybe not just not one, but all their monthly debt collectively is $750. Now this same family can only purchase up to $622. So I'm going to show you guys from the beginning. If you have zero debt, this family can afford $733. With $250 debt, they drop to $696. If they have monthly debt of $750, they drop to $622. So your monthly debt plays a big role when it comes to qualification and your affordability. And guys, if you have already purchased a house, your job should be to make your payments. That's one. And then try to make extra payments so you can pay off your loan earlier, and it will have two positive effects. It will save you a lot of years, and it will save you interest over the time. So in this example here, if the principal and interest, their payment is 3,700, 3,771, and they decide to make extra payments of $300 over the course of the term of their loan, they can save up to 6 years. So that loan that they have for 36 or 30 years, that can turn into 24 years, and they're going to save $192,000. So your situation may be different, but the concept is the same. You want to call up your lender and say, hey, I want to start making extra payments towards my principal. So that way I can chop down some years from the back end. Next, guys, your inflation is at 3.3 as of the last reading. Then in January, it was went to 3.1. So we want to keep seeing that inflation rate come down. As long as it's coming down, we should be able to see the interest rate come down in the next meeting, Fed meeting that they will have. We're hoping for that. We hope they do cut the rates. But how about the home prices, guys? You guys have noticed it over the years that the prices have skyrocketed in some counties, some area. Don't expect them to come down when the interest rates come down too, right? It's just simple as supply and demand. You're gonna have more people that's gonna qualify for the same property as you do, so there will be bidding wars and the prices will go up instead of going down. So, just make sure if you can find a property now with less people competing with you, you might be able to find a good deal. Next, guys, we always want to talk about one loan program for you guys. So today we want to talk about FHA. There are a lot of pros and cons to FHA. You want to know, hey, that is an option for me. Let me compare that with my other options as conventional loan and see which one I want to go with. So for FHA, you need credit scores of 580 or more. If you have more than 580, that's good. You qualify for FHA. If your down payment, you can put down as low as 3.5% down payment. You can have your debt to income ratio as high as 54%, and your closing cost is typically 4 to 6% for this type of FHA loan. Some of the negatives, one of them is that FHA comes with upfront cost of 1.75%, which is a one-time fee. It can be added to the loan, but you're still paying for it. With conventional, you can avoid this fee 1.75%. Second is your mortgage insurance. Let's say you want to go with 3.5% down payment. Your mortgage insurance will never go away if you go with 3.5%. Okay? If you were to put down 10% or more, then it does go away, but after 11 years. So FHA, think of it as like a helping hand. If you don't have you don't have good credit scores, right above 620. Most of the conventional loans you need 620 or more. So if you land below that, then you might have to go with FHA. But just know your options. Also with FHA, it got to be your primary residence. You have to live there. If you don't live there, you cannot go with this. Then you have to go with conventional and now with FHA. And for FHA, you can get up to 4 units. Do you have to live in all 4 units? No. You're going to rent out all 3 units and you have to live in one of those. Okay, that is your loan program for FHA. So you always want to compare, go to different loan officers and say, hey, give me the guidelines. Tell me what I qualify under FHA and under conventional. So this way you can choose wisely. All right, guys. Next, we have some new listings here. One of them is in Jamaica, Queens. Here is listed for 1.399, 2 families, 6 bedrooms, 5 bathrooms, brand new construction. So you guys can check that out. Another one is in Belrose here. This is a co-op for 2 bedrooms, 1 bath, listed for 260. Another one is in Franklin Square here, single family, listed for 1.239, 5 bedrooms, 2.5 baths, huge lot size, brand new. And another one is in Jamaica here, listed for 839, 5 bedrooms, 2 baths. The lot size is fairly small, 2,600 square feet. So this might be great for investment. So if you're looking for a huge lot, maybe Franklin Square might be good for you. So you guys can check out different inventory that we have on ljrealtyteam.net. Next, guys, we want to teach you guys one term to learn for real estate, especially if you're a first-time home buyer. One of them is called balloon payment. It's a large lump sum payment, one-time payment due at end of the term for that loan. So let's say you end up getting a loan that has a balloon payment. That means, let's say that balloon payment is due in 5 years. So you're making your payments, you're making your payments. After 5 years, you get a mail saying that you need to pay off your remaining of the balance in one shot. How are you going to do that? So it's never recommended for a first-time home buyer. It might be a good option for an investor, meaning they're going to buy the house, they're going to renovate it, flip it, and they know they're going to do the whole 9 yards within 1 to 2 years. and there's no surprise. They know there's a balloon payment due in 5 years, but they're going to get that done before that. But not a first time home buyer. First time home buyer, if my payment is $3,000 first month, I want that to remain same for rest of the for 30 years, and I don't want any balloon payment. So when you're talking to your loan officer, make sure it will also be listed on your loan estimate. Does this loan have balloon payment? If it says yes, that's a red flag for you. Speak to your loan officer, get more details, and stay protected, guys. Next, we're going to talk about some stats. According to MBS Highway here, your appreciation over the years for 5 years, 10 years, up to 63 years in Queens here, you guys can see that the house prices have appreciated over 4%. And with Nassau, it's very similar, very close to 4% as well. So if you think the price is going to come down anytime soon, is most likely it's not going to happen. Next, we always want to talk about one person that's going to be really important in your transaction, in your real estate transaction, that's going to help you, guide you, and help you purchase the property. So today, let's talk about your appraisal. Number six, right? Your appraisal. This person, you're paying this appraisal person to come to your house, but you're not directly hiring them. Your lender, the bank that you're getting the loan from, they're hiring this appraisal, and that person is going to come in and compare your property with other properties in the neighborhood. We know your real estate agent did that when he was putting or she was putting in the offer, but now appraisal is a third party. They're going to verify that. So if you're going to buy a house for $500,000, the appraisal is going to make sure that the property value is $500,000. If it's less than $500,000, then we have a problem, right? Then it has to be resolved. There's a couple of things that can happen. One, if the contract that you're in, if the contract has bank appraisal contingency, that's going to protect you. It's simply saying that, hey, whatever I'm paying $500,000 to you, Mr. Seller, I want to make sure my bank agrees with that through a bank appraisal. Okay? If the value comes lower, you have the right to back out, cancel it. If you really like the property and you have funds available, let's say it came down $10,000 and you want to pay from your pocket, then you can do that. But you want to have bank appraisal contingency, and you want to do a bank appraisal when the time comes to protect yourself. All right, guys. Next we have is your budget. If you're going to purchase or thinking about buying a house in 2024, you need to see how much income you have. We showed you a scenario earlier. Your debt matters a lot. You can be making X amount of money, but with your debt that's increasing on monthly basis plays a big role in your affordability and your credit scores as well. So when it comes to your savings and your down payment, don't forget we have to have your down payment and we need your closing cost. You need both. So down payment you can put down as low as 3%, but closing cost also 3 to 5%. Make sure you have enough of both. And when it comes to your credit scores, you want to have goals for your life. That, hey, I'm going to buy a house. I want my all my options. So why not have my increase my credit score as much as possible? So if your credit scores are below 500, you want to have a target of fixing your credit scores and bringing it at least to 580 so you qualify for FHA. If they're already at 580, your goal should be 620. Hey, let me take it to 620 and get my all my options. If you're going with no income check loans, these are, DSCR, bank statement loans, 1099 loans, then you need 690 or more. And guys, we're showing you guys the national averages for mortgages, right? So if someone tells you, hey, I can give you 5%, 4%, any low number, you have to ask that person, hey, are you saying this because I'm going to buy down the rate? If yes, how much is going to cost me and how much money is going to save me every month? So in this case, if it's going to save me $4,000, it's going to cost me $4,000, but if it's going to save me $82, $4,000 divided by 82 is going to take me 4 years to get that money back. So you be the judge to say, hey, if it makes sense for to buy down the rate or not. Next, guys, we have about 16 loan officers here at LJ Mortgage that can help you guys, guide you guys, speak with about different guidelines for FHA and conventional. You guys can reach out to us. On that note, if you're a real estate agent watching this, guys, we have 100% commission available to those people who perform well, that can get up to level four. There's no office fees, no desk fees. We provide you with all the tools so you guys can connect with us on that note. Otherwise, that will do it, guys. Thank you so much for joining. I will see you next time.